Hello, everybody, and welcome back to the show. This is Taking Stock. Thank you very much for joining me this Friday afternoon. Please do give me your comments and your suggestions and requests for today, because I think I'll be able to cover the news reasonably quickly. Let's hop straight into it, and I'll share my screen. Okay, so yeah, thank you, El Saint, Non-Farm Payrolls Friday. Thank you for that. Okay, so we've got SYME Capital, and it's down by 6%, as you can see. And we've got a business update from the company. This is one of the most read RNSs, and this company's been it's been around a while, and I have studied it before. I think that the idea is they have a blockchain technology, and what they will enable companies to do is to monetize their inventory. So essentially link up a company's inventory, whatever that may be, to the blockchain, and then sell it for in advance using the crypto technology. So I think that's the idea. As you may know, I'm not a huge crypto person. I've not been totally won over by the practical benefits of crypto technology, but I try to keep an open mind. But in the case of SYME Capital, they've been around a while. As I say, they always seem to be promising things, but revenues haven't really materialized yet. So never say never, but let's see what they're telling us today. So we have a business update. Progress made on all the ongoing streams. So this is what they say. The company announced that SYME and a working group have been working closely to draft, review, and finalize the detailed commercial contracts which will implement the commitment received from this Italian bank. And they've been progressing the onboarding of identified remarketers. So quite a bit of jargon here. But what does it mean in terms of revenue? Is the company going to generate serious revenues anytime soon? Let's see what we get in the next section. They continue to make solid progress in structuring a security token framework with this company owned by this other company, which will allow a first security token issuance up to $100 million to be subscribed in tranches. So it seems as if this is still in the works. Not actually happening quite yet, but they are working on it. Now, this next paragraph sounds a little bit closer to happening. They confirm that through the strategic partnership with this company, they have secured a commitment of $5 million from an asset manager specialized in digital assets, and the team is working alongside a crypto exchange and an investment bank to raise an additional ticket worth $5 million. So this $5 million is not revenue. It is the value of the assets that could potentially be monetized. So unfortunately, I don't think this means we've got real, substantial revenue at SYME, but they're still working on it. When I previously studied this company, I thought that its balance sheet was rather weak, and I also noticed that there were quite a few related party transactions. So I'm certainly open to changing my mind on this one, but I haven't seen a whole lot here that looks investment grade, let's say. But good luck to them, and hopefully we will see material revenues at some point before too long. But yeah, I mean, feel free to let me know what you think. I don't understand the point of connecting assets to the blockchain. I don't understand why we can't do that on with existing technology. You have an Excel spreadsheet and you create a list of your assets. I don't know why you need a blockchain, if you like, to map out your assets, but it's an interesting idea. Let's move on to another company. Let's move on to ROQ, Roquefort Therapeutics. And this company's shares are down by, again today. And again, this is another very small company, but it's quite a dramatic RNS that they released, where they said that they noted recent bulletin board speculation about a placing that the company may be undertaking. They recently engaged advisors to commence a process of market soundings in relation to a potential fundraise. However, in response to incorrect bulletin board comments regarding a speculative placing price and resulting unusual share price movements, the board has decided to not proceed with any potential placing at this time. So, people need to be very careful on the bulletin boards. When you say things that aren't true on the bulletin boards about fundraisings, it can be very risky. Not just from a legal perspective, but it can have real world effects. Who knows what the truth here is about what fundraise may have been possible, but the share price here has fallen considerably. See, it was about 7 or 8p, and it's now down at 4p in the last few days. So who knows what exactly has driven that, but people do need to be very careful saying things that aren't true on the bulletin boards. I think this one, you can tell from the very low market cap, but this is one of the very speculative sort of bio companies. We've got no revenues up until 2022 and losses. So this one's very early stage, and it may be that they do need a fundraise. So I wonder what price they will eventually get if they go ahead and do that. Okay, let's move on to one of my old favorites, Argo blockchain. This is a sort of a chastened version of its former self. This company's gone through quite a lot of iterations and different business models and different management teams. Now they've got a new CEO. I see they raised money in January at 20p, so down at 12p now. So it's been tough for Bitcoin miners. I suppose this is a bit of a crypto themed post today, given we've already covered one crypto company. But yeah, Argo is. Let's see what they're telling us today. They've got a March operational update. So they've mined 103 Bitcoin in the month of March. And the price of a Bitcoin is about $62,000 currently. So certainly that should be a big help. I think gold is $2,300. So both of those sort of similar type assets are doing very well. But yeah, so with 103 Bitcoin at $62,000 each, current spot price, that seems to be a pretty decent amount of revenue. 6 million, I guess. And they had a 5% increase in production despite 4% higher average network difficulty. So that seems to be pretty decent, a decent operational performance. They've moved facilities. They actually generated $7 million of revenue. And they hold 26 Bitcoins on the balance sheet. And the CEO tells us, "I'm pleased by the increase in daily Bitcoin production, despite an increase to average network difficulty and downtime from relocating our miners. As we approach the halving, we continue to focus on streamlining our operations and running as efficiently as possible." So I think it's important to look at this company with fresh eyes. They have raised new money. They've changed their operations a lot. I think they were in Texas before. They were somewhere else. The previous management, had a very different outlook. The previous business model here was very different. If you go back to the early days, they were trying to provide investors with a mining as a service, kind of a strange business model. And then they moved on to simply mining for their own account. Having raised money, maybe there's a chance that this can get back onto more solid footing. But I looked at their Q3 results, and the Q3 results did show a net loss of $10 million. I guess that will have been at a lower Bitcoin price. So maybe that's changed. That their Q4, Q1 results could be a lot better than that. But it is tough. It is tough for the miners because Bitcoin has been created. I mean, in some ways, it is a genius invention. The way it was created, that mining became incrementally more difficult, and so the complexity of mining Bitcoin gets harder and harder, and that is a good thing in terms of making Bitcoin more scarce. But it means as a miner, you've always got that sort of headwind to fight against, and that's what Argo blockchain is sort of constantly fighting against, this headwind that unless the Bitcoin price does rise over time, they have to deal with this much more difficult complexity of mining. So yeah, good luck to Argo blockchain, but it does it is a tricky one. Okay, let's move on to Pendragon, or Pinewood, as it's called now. So this is a sort of a special situation. As you can see, this is a large company now. We've moved into the bigger territory. Market cap 677 million. So trading at 39p currently. There's a special dividend that's going to be winging its way to shareholders. So £358 million being returned to shareholders. So as you can see, it's 24.5p per existing share. And On top of that, the other news is that there's going to be a share consolidation here, so that for one new ordinary share will be issued for every 20 existing ordinary shares. So that makes sense when you have a much smaller company following a disposal and a return of capital. You're left with a much smaller company. I think it makes sense to consolidate the shares and have fewer shares, which will have a higher individual share price. So, and it's a good principle to watch out for, when companies choose to make, individual disposals like this. It does tend to suggest that they're looking out for shareholders, because all the incentives are really in the other direction. The incentives are usually to make acquisitions. In the case of Pinewood, we've got a very large disposal of a motor dealership, and we've got the retention of a software business. So separation of a dealership and a software business. And I think if you go back and you read your textbooks, they'll all tell you that companies get a higher valuation when they're separated rather than mixed together in a sort of conglomerate structure, because the problem for investors is it's very difficult to value a combination of different businesses, whereas when you've got them separated, you can value them individually at a higher price. So yeah, this is the old Pendragon business, now called Pinewood Technologies. Seems pretty interesting. Seems like a pretty decent software business, and it'll be interesting to see what sort of new earnings multiples and valuations we get for the standalone business. Okay, so as I said, please do hit me with your suggestions and your requests. Seeing as the news is light today, I thought I would just take a minute and try and reflect on what I think works in investing, based on a combination of my personal experience and what I've read. So let's start with what I think works. The first category I would say that works is when you find a company that has large monopolistic growth. So like in an American context, you've got the Magnificent Seven. You've got the likes of Microsoft and Alphabet, which I'm a shareholder in. You've got the companies where they have a market share of something that's very large, like obviously over 50%, but preferably more like 80 or 90%. And when you find a company like that, which is also growing, then you have the ingredients for a spectacular return. Of course, it's much easier said than done. A lot of the time, these companies are carving out new industries that didn't exist before, new types of products that didn't exist. Now, in a UK context, like one company that I own that's done okay, but it's not done as well as I hoped yet, is Rightmove. So that's a share I own where I consider it to be a monopoly because of its incredible power, its incredible market share of eyeballs. So when somebody wants to look up a property, there's an over 90% chance that they're going to use Rightmove. Thank you for the question, George. I'll get back to that in a minute. Appreciate it very much. I will get back to you. So with Rightmove, there's an over, there's a 90% market share. And so for me, that was very exciting. And let's see if we can get a slightly bigger chart here. So, I mean, just over the last year, that large fall that happened was due to a concern over competition. There is a risk of competition, but I think it's tough. I think it's very tough for competitors, and so the main drawback with Rightmove as an investment has been that it hasn't grown. It's in a mature industry, and it is already controlling the market. So it's difficult for it to keep growing. It can only really grow as large as the market that it's in is growing, which maybe isn't that fast. It's kind of, maybe you could say it's as big as it's growing as fast as the economy is growing, essentially. George says, I tend to use Rightmove. Zoopla is helpful for looking at valuation estimates with a free account. Yeah. So I think most people will use Rightmove most of the time, and then they might check Zoopla as well. But most people will use Rightmove most of the time. So Rightmove, I think, is an example where it is a monopolistic type of company, but it hasn't got the growth attributes that you'd really want to see a multi-bagger. I do own it, and I do think that I'll do okay with it long term, but it hasn't really grown. Now, if you follow me over on Stockopedia, one of my big winners over the last year has been Trustpilot, where I put that on a best ideas list, and that has been a multi-bagger. So I'm trying to pull up a 1-year chart here. So this one's okay. This isn't a very long-term chart, but basically you can see Trustpilot's doing very well. And I consider Trustpilot to be a monopoly type of company, in the sense that there is a category of product which it has basically created, which is providing a review service, and there is nobody really doing it as well as them or anything like them. So for me, Trustpilot is an example which is working for me right now, in the sense that I've put it on my best ideas list and it's performed very, very well. So in that's an example where there is growth, because I think I've got in early enough with I'll go back to George. That's my first category of the type of investment approach that I think can work. George asked a question. He said, at a high level, what method do you use to find and research stocks? Are there any key metrics you like to look at? So I mean, as you may know, I'm a small cap analyst, and I just tend to read a lot of RNSs. So in terms of finding stocks, I think that just being interested in the stock exchange newsfeed is a good start, because by just reading announcements, you'll tend to pick up a lot of ideas. When it comes to researching stocks, I think you want to read annual reports and read announcements, and just being interested in companies. And then in terms of metrics, I'm a big fan of the quality metrics. They're my main ones. Return on capital, return on equity. They're my favorite ones. Operating margin is a good one. Gross margin as well, depending on the industry. So yeah, I mean, nothing too crazy. I just like good quality metrics. But I understand that some companies will temporarily have bad metrics, but you want to look out for situations where it can improve. All right, so I've covered my first category of investment that I think can really work, which is when you have a monopolistic type of company where it's in it category where it's the number one, and if it grows, then you can earn incredible returns because the company's profits will explode. Like in the case of Trustpilot, they've gone from being loss-making to being profitable, and because in my opinion, there is no real competition facing them. They're sort of free to sort of increase their profits without, it's not as if their competitor is going to suddenly come in and cut prices, because there is no competitor. So Trustpilot is just free to make money, in my opinion. And a similar argument with Rightmove. Rightmove's competitors can try to compete on price, but it's not easy because everybody wants to be on Rightmove. The basis of the Rightmove monopoly is that it's a marketplace. There's buyers and sellers, so everybody wants to be there to have the visibility of all the other buyers and sellers. The basis of the Trustpilot monopoly, in my opinion, is that it's a new category that nobody else really influences or has any control over. And yeah, thanks for that, George. You're very welcome. Okay, so that's my first category. The second category of investment that I think can work is when you have a company that's maybe of low quality, but where you have sufficient insight to judge its recovery prospects. So the stuff I was just talking about was all really high quality companies, Microsoft, Alphabet, say Amazon, Facebook, or Meta. Then you've got Rightmove, Trustpilot, more companies like this in the UK. Well, there aren't a whole lot of monopolistic UK-based companies. Maybe Auto Trader. But the second category is the poor quality companies or the lower quality companies, where they have temporary problems, but where you can judge their recovery prospects. So an example would be, okay, so you could have economically geared companies where you can judge that this is a good point in the cycle. Now, that is, in my opinion, this is quite difficult to judge things from an economic point of view. Let's see if we can get up British land. So, like, if you have insights into property, for example, maybe it's possible to invest in REITs, real estate investment trusts, house builders, and these sorts of companies where you can judge the timing. Now, it's a sort of open question on whether anybody can predict the economy. It's not easy. Some people argue that it's not even possible. The way I approach it is that I do think when you study a company, especially something like a house builder, you get valuation metrics that are fluctuating all the time. I suppose it's the old Mr. Market argument. Mr. Market is sometimes euphoric, he's sometimes depressed. And I think sometimes you can be offered a REIT or a house builder at a very attractive valuation. So what I typically do with the REITs, for example, is that I will just look for a discount to book value. And if I get a big discount to book value, I will tend to say that I think it's attractive, especially if it's something like a 30 or 40% discount to NAV, to net asset value. Then I tend to get really interested because I think it's difficult to lose money in that situation. Of course, quite a lot of patience might be required, because nobody knows how long it will take for interest rates to fall, for house prices to rise, for the mortgage market to recover, and so on. So in the same way, you can do that with the house builders. You can also do it with the banks. You can try. I mean, I think the banks are even, well, they're on a different level of difficulty. I would say the banking system is extremely difficult to analyze. So, I mean, good luck if you feel you're up to it. But it's something that people can do. What I do is, and here's an example of something that's actually worked for me, is I look for companies where it may not be a very high quality company, but where I do have some kind of insight into the market. So the typical example here is CMC. Now this has been an enormous stock for me because, again, if you're over on Stockopedia, I put this on my best ideas list for 2024. And it's been a multi-bagger in a very short period of time. And the way I figured it, that I needed to put it on my list was, I feel like I understood the volatility that's inherent with this stock. I mean, some of you may even be CMC customers. I suppose I should disclose that I'm an IG shareholder. I do own shares in IG, which hasn't performed quite as well as CMC in terms of the share price. But CMC is an example of a company where its short-term financial results were poor, but I felt like I had an insight into the company's ability to rebound based on trading activity, and also the valuation became very cheap against book value. Yeah, thank you for that comment, George. Appreciate it. So with CMC, again, it's a combination of cheap valuation and the company is temporarily unprofitable, but I didn't believe that it would be permanently unprofitable. And so this is where, if you study particular companies, you can try to catch the temporary weaknesses. I mean, this is stuff that Warren Buffett did. From time to time, he would try to buy into a very high quality company that had a specific short-term problem. So that was something that he did quite regularly, I believe. So look for companies which have temporary problems that will rebound. And the reason I would say CMC is not a very high quality company is that it is subject to volatile performance. It will perform badly when people stop trading, but when people do start trading again, it does extremely well. So that's my argument there on CMC, and my general argument is try to understand particular companies. It doesn't have to be, you don't have to understand every company. Try to understand particular companies very well, and then you will be able to catch them when they're cheap. So that's your circle of competence. Let me give a third category of stock that I think can do well. The third category is where you find a brand that has a lot of potential. So now this could be a mature brand or a less mature brand. So in the beverages, for example, Coca-Cola was a brand that did extremely well for many years. But if you wanted to do really well with a beverage stock, you really needed to own Monster Beverage. So if you haven't heard of it, look it up. Monster Beverage, one of the best performing stocks in recent decades. And that basically appeared out of nowhere, and a lot of people, they don't drink the stuff, so they're sort of blind to it, but it's there everywhere you go. You'll see a Monster Beverage, and that's an example of a brand that took off. And so it's a lot more difficult if you're investing in Coke in 2024 in the Coca-Cola company. It's going to be a lot more difficult to make a multi-bagger. So the challenge, if you're up for it, is to find a brand that is young, that has a lot of runway. And I think in the UK context, like I personally own shares in Burberry, which I think is an incredible brand. However, again, this is a bit like my Rightmove, and so these mature brands, they don't grow as fast as the young brands, and that is a challenge. So I'm not putting myself out there as someone who is an expert at finding young brands that have a lot of growth potential, but I do invest in the older brands, and I still, again, go back to my 2024 list over on Stockopedia. You'll find the entire list. I have talked about companies like AG Bar and Nichols, which own the Iron Brew and Vimto soft drink brands, and so I do think there's a good opportunity in older companies which own the older brands. I think that they can still do very well as long-term investments, but I admit that they're not going to grow as impressively as something like Monster Beverage. Now, some people would have a much harsher opinion on the older brands than I would. So, for example, if you've ever heard of a fellow called Edwin Dorsey who writes The Bear Cave, he's been putting out short reports on the likes of Hershey's, the chocolate brand, because he suggests that the old brands are going to become irrelevant in the face of competition from startups. So again, this may be, I don't know if my audience is familiar with any of this, but one of the biggest YouTube channels is Mr. Beast. Absolutely massive, very entertaining. I have watched some of his videos, and he has his own chocolate brand now, and that is all the rage. If you've got nephews or grandkids who are watching these YouTube channels are launching chocolate now, or they're launching soft drinks, and that is a risk to the existing brands. So something to maybe be aware of. I don't know if I fully agree. I think Hershey's is still going to be around 20, 30, 40 years from now. Maybe it won't have quite the same market share as it does currently, but I still think it'll be around. Same with the likes of Cadbury's. Do you think Cadbury's is vulnerable to competition? Personally, I would say Cadbury's is not vulnerable to competition, but there's certainly going to be a threat of new brands, especially from these social media stars. Okay, so those are my categories of investment which I think work very well. Temporary weakness in a lower quality company where you understand the source of the weakness, and brands that are young that have room to grow. So I tend to focus on them quite a lot. Like, you could create probably an infinite number of categories of type of investment that could work. Like, a lot of the stocks that I cover are financial stocks where I just think that they're too cheap. But I don't know if I want to make a special category for them. I don't know what I'd call that exactly, but I do think there's a lot of very cheap financial stocks out there, especially in the UK market, and in the small cap market. I'm sure many of you have studied, other types of companies that I don't understand or that I haven't seen before. Could be in the mining sector, could be something high tech, could be something crypto. But whatever it is, we all need to have our own little specialisms, our own little areas of expertise, because nobody can be an expert in everything. Yeah, so just before I wrap up for today, I should mention that I'm not just a passive shareholder in Alphabet. I'm also an ardent believer in their technology, and I have a new Google Pixel phone arriving this afternoon, and yeah, I'm very curious to see what it's like. It's a Pixel. Some people say that it's an iPhone killer. I'm not sure if that's going to turn out to be true or not, but people thought that, or a lot of people still think that the iPhone is going to be permanently sort of in control of the high-end phone market. But I don't know. I'm open to the idea that Google or Alphabet could potentially win over the throne at some point, or somebody else. But yeah, as I said, I'm not just a passive shareholder in Alphabet. I'm also a believer in the technology, and I'm looking forward to trying out my new Pixel this afternoon. It's amazing how when you get locked into these companies, you can you really can feel like there's no escaping from them. When you use the Gmail, you use Google for your photos, for your address book, for your calendar. So many different aspects of your life. In some ways, Google knows you better than you know yourself. The sort of the news suggestions that it makes for me, the product suggestions that it makes for me, and that's I suppose this comes back to my point about monopolistic companies. I do think that Google or Alphabet's collection of monopolies is absolutely incredible. The best maps product, the best search engine, the best web browser, the best email service. It's absolutely an incredible set of monopolies. I mean, any single one of those products would be worth billions and billions of dollars. If you took Google Maps as a standalone product, what would that be worth? Considering that it is far better than any alternative and has a completely controlling market share of its niche. Just that product alone, and that's only one aspect of the company. So yeah, as you may tell, I'm a big believer in Alphabet, talking my own book. But yeah, that's one of my favorite shares, and I've been holding it for years. And I suppose I'm not somebody who's abandoned UK shares. I do most of my portfolio is still UK, but I have dabbled in some US shares as well, and I've done reasonably well in Alphabet and in Berkshire Hathaway. Okay, sorry for rambling. Thanks, as always, for joining me. Thank you to George and El Saint for the comments in the live chat. I appreciate the thumbs up very much. It really helps the channel a lot and helps to keep things going here. So do appreciate that a lot. And have a nice weekend. Hopefully next Monday we'll have a lot more news to cover. I'm sure we will. Fridays are always a little bit quiet in the markets, but maybe that will be something I do in the future when we have a quiet day in the markets. I'll just go on a ramble, and yeah, I hope you got some value out of that, and have a great weekend, and I'll see you next time. Cheers.